Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris Rapeseed, Winnipeg Canola, and Malaysian palm oil.
Paris Rapeseed. Since the low in mid-March, where we saw the fall ending with a hammer pattern, we've seen a V-bottom, and then overall, prices very gradually moving higher in what I initially thought might be a possible ascending triangle pattern, but which became an ascending wedge pattern. The lower trend line for both is the bright red mid-March to day uptrend, currently at 477 and a quarter. And initially I chose not to draw a new trend line on the top side, but instead rely on two previously highlighted features. The first is the fairly flatlining and now rising gold long moving average, currently at 497 and 3/4, and or the dark blue neckline extension, currently 496 and a quarter, to the April to August 2024 head and shoulders top. Now, we had attempts higher over both of these over most of mid-May, but we finally had a really concerted attempt higher 4 weeks ago. But though it initially looked good, a gapping changeover move lower, but the market put the market back down within the body of the ascending wedge pattern again. The fall was held up eventually actually, by the bright green, very shallow neckline extension, currently 480 and 3/4 of the August to September 2024 head and shoulders top. A neckline that had acted as a resistance in April and a sort of support at the change from May into June. We also had support from the mauve medium moving average, currently at 483 even, and I suppose also the green short medium moving average, currently 486 even, plus the congestion area between the bright green neckline extension and the 50% Fibonacci line of the May 23 to January 25 move at 467 and a quarter. So overall, we're once again in the immediate future, supported by this congestion zone below and capped again by the gold long moving average above. Nevertheless, last week I decided to lay out some potential targets topside for this ascending wedge pattern, though as I said last week, and I quote, I freely admit I have doubts about them and would consider some immediate retirement should prices drop down below that congestion zone below, end of quote. Thus a primary target X is up in the 521 area, just above the congestion overhead between 514 even to 519 and a half. That capped prices 3 weeks ago, plus a secondary harder to reach target X1 up in the 537 even area. This one looks very hard to achieve until you realize that we have limited overhead congestion past the congestion between 514 to 519 and a half that capped the rise 2 weeks ago. Beyond that, well, it looks quite clear now. But first, we have to get up there, and that is something the market did not manage to do this week. It's just not really got the incentive at the moment. Prices have instead started to test the downside and closed down below the bright red lower trend line of the ascending wedge pattern for the first time. Yesterday is a bit early for downside targets, but bearing in mind the topside targets, which now seem very, very moot, I think I might risk laying out some of the targets below to balance the upside. Thus, our primary target X2 is down at 462 even, underneath the 50% Fibonacci of the May 23 to January 25 move at 467 and a quarter, but just above the late April low at 461 even. We also have a secondary harder to achieve target, much harder to reach target, X3 down at 433 and a half. A target that seems very much out of reach. Winnipeg Canola. Back in mid-May, we started to run into some serious overhead resistances. Specifically, some resistance I mentioned 10 weeks ago, and I quote, some generated congestion roughly between 723.70 to 735.20, plus a recent ascending lower wedge trend line extension, end of quote. Now, also added 8 weeks ago, the neckline extension of the old August to October 2024 reverse head and shoulders continuation pattern, which is currently at 755.10. This one has been particularly good at capping the market as recently as 3 weeks ago. And at the start of 2 weeks ago, and the only reason I didn't mention it earlier was, I thought back then, that the 723.70 to 735.20 congestion area overhead might have been enough. In the end, we had a gapping changeover lower 8 weeks ago, leading to what can best be described as a somewhat artificial weekly key reversal down. Prices have since tried to recover, but the initial rise in late May and early June was tempered on approach to the overhead 50% Fibonacci line of the July 23 to September 24 move at 700.5, before finally breaking higher mid-June and filling in the changeover gap. All this from the ammunition gathered in earlier drop down as we entered June, down to the previous mid-May low in 664.10 zone, which is coincident with the November 24 high and the interesting 38.2% Fibonacci on the same 23 to September 24 move that the 50% Fibonacci line above had capped prices, plus the not insignificant rising green short medium moving average, currently 701.70. So all these halted the decline at the turn from May into June. Now, as I said 4 weeks ago at the end of my commentary, and I quote, "So what have we growing here as a pattern?" Well, I'm not too sure, but if I was to hazard a very really outside idea, then I would look at the action recently as possibly a bearish cat's ears pattern, or less outrageously, maybe a double bottom, end of quote. Well, since then we have seen the formation of the easier double bottom pattern. This followed on higher to reach both the primary and secondary topside targets. But then 3 weeks ago the market became capped by the previously mentioned dark blue neckline, dropping back down in a stepping motion down to below the green short medium moving average and below the 50% Fibonacci line at 700.5. We are back down to today, down to levels seen in early June, just above the lesser Fibonacci line at 678.40 and a little above the mauve medium moving average. Last week I indicated we might forming a possible mid-May to date bull channel. This was an early possibility which, well, has not borne fruit, and I will retire this idea now. This has left us somewhat rudderless with a possible topping action, but no significant patterns as yet emerging. We might still form some other pattern, I'll watch out for that, but for now I don't see any major patterns as yet, and for those who actually ask, no, I am not comfortable drawing fresh bullish Andrews or shift pitchforks on what looks like unstable ground right now. Bursa Malaysia, crude palm oil. There are some market features that have helped hold up the market, but some of which have now given way, and others that are being tested and seem good supports right now. To start with, I'd look at the wide congestion area now overhead between 44.08 to 45.59. Now this was support, but is now resistance and is being tested right now. Next, there's the significant combination of the 38.2% Fibonacci line, the May 20 to March 23 move, and the 50% Fibonacci line of the May 23 to December 2024 move, both at 42.74, being joined recently and now separating away by the declining medium moving average, currently 41.98, which interestingly capped prices yesterday right from the open plus the nearby lesser Fibonacci line just below at 42.39. On these I said 12 weeks ago, and I quote, "It seems that some significant bearish pressure is meeting some quite substantial bullish supports. Something has got to give, and for now it's looking like downside might. If it does, then apart from the July 23 high at 41.89, we might not have anything of note below until the congestion starting at 40.26, end of quote." By the way, I did the word caution on that quote, so that's the end of the quote. Well, 12 weeks ago we gapped lower and dropped down through that 40.26 zone, briefly trying to become an elastic move back up, trying to fill the gap left behind, but failing to do so, and making another smaller gap lower 10 weeks ago. And that's pushing down to and through the interesting dark blue neckline extension, currently at 38.75, and that's of the small late May to April 2024 reverse head and shoulders bottom. Now, I had said 10 weeks ago about this dark blue neckline, and I quote, "This is one to watch on the downside, as it is the core, a large April to September 2024 congestion band on the downside, as it is the core of the large April to September 2024 congestion zone, stretching from roughly 3750 to 4100, end of quote. I also added at the same time, back then, and I quote, "These actions have brought to my mind another new pattern that may be just about completing, but which can even now still be derailed. Is to look at the whole move down from the high back in early December 2024 to date as a really big halfway hesitation. To give an idea of the potential on the downside, we have a possible target X down at 3750. And that's right on the far end of the congestion we sit within right now. End of quote. Well, 3 weeks ago, we reached down and achieved the target at 3750, even overshot it a bit, but we've had since then a reactionary move back up, such that the dark blue neckline extension is now a key support. Resistance, and more likely actually a congestion point, all at the same time. Importantly, we have since also started to try and move higher with what turned out to be, as I said 4 weeks ago, and I quote, a possible, if imperfect, bright red ascending triangle pattern formed over May to date. It is a small pattern, and I would gain the action outside the action over yesterday and the day before, as an attempted false break on the downside that so far has failed. Now, false breaks, coming as they do so far along the triangle and so close to the tip, are not unexpected. And whilst I cannot as yet give definitive targets for either side, I can give an idea of the potentials involved. Plus, thus, a true confirmed break higher over the bright red upper trend line will have a potential of plus 298 ringgits, whilst a true confirmed break lower below the bright red lower trend line will have a primary potential of minus 131 ringgits, with a secondary hard reach potential at minus 298 ringgits. And that's the end of the quote. Since then, with what we have seen as an attempted stabilization over the bright red lower trend line, this equates to a primary focus X at X topside in the 4190 area, and a secondary harder to achieve target X up in the 4779 area. In many ways, these two areas encapsulate the next area of congestion overhead. Yesterday, the market reached up and opened over target X, as it capped as it was by the mauve medium moving average. Though I still have hopes for target X, X1 further up at 42.79. Whilst there is only one other feature I would like to discuss, and this came about because of the end of June, speaking about it in a presentation at the Biofuels International Conference and Expo in Belgium, Brussels. It was and is to watch out for a key level from now until the end of this year, and that level should be 35.99. If we push down below 35.99 before the end of the year, then we would have set up the conditions in a palm oil weakness in palm oil itself to make that rarest of patterns an annual key reversal pattern, with all the implications that such a huge longer term pattern may bring. So please watch out for this, as it is important. I'll bring you more details should we get down there.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.